Impulse waves are the heart of wealth generation because stocks spend most of their time sitting and then they suddenly spring up. And these are some examples. AMR, which is a call stock in 2021, sat for about 160 days and then it springs up and does 340% in just 155 days. INSW, the shipping stock, it is seated for several years and then all of a sudden it moves 160% in just 4 months. There's so many examples. It happens every year. Li, which is from China, an automotive stock, sits for 3 months and then does an 80% move in 90 days. Mar, this was one of my favorite stocks from 2023. Created a lot of profits for me. It sits for 120 days and does nothing. All of a sudden, it jumps out and it does 250% in only 40 days. So it went up times 3.5. NVDA, which has brought me a lot of profits in 2024, sat for 175 days. Jumped out around in January, then it first did 95% in 60 days, corrected for about 40 days, and then it moved up another 40%. It's currently moving, and we don't know where it's heading, but it's been really interesting to make a lot of profit from such a huge move. SMCI, same story, AI, semiconductors, sits for about 5.5 months, not doing anything, and suddenly jumps out in January and it moves from $300 to $1,000, 200% times 3 in just 50 days. So you see, it sat for 5 months, but only moved up in 50 days. Also, it did the same thing in 2023. It didn't move anywhere. If we look at this price chart, it was around $90 for a long time, for about 160 days. And then all of a sudden, it jumps up around $100. So it moves from 100 to 340, 220% in 97 days. And you can see the entry day where you could have entered. VITL. I'm showing you all of these stocks so that you know how powerful mastering this lesson is going to make you and how it can make you money in the years to come. Sits for several years, jumps out, currently moving. I would have exited at around 40, but you can see it did 200% in 100 days. Tesla in 2023, just a very short consolidation, sits for about 90 days, then it moves up 70% in 65 days. So you can see that stocks don't move a lot of the time. They're sitting for most of the time, and then they suddenly spring. Tesla did the same thing in 2020, sat for 77 days. This is actually one of the trades that I took, but I sold too early. I didn't know what I didn't know. So I sold around 180, but you see it went from 140 to 280. So it did a 120% move in only 70 days. The power of compounding. Now, a lot of people out there say that getting 50% return a year is tough, and it is tough to move your account up 50%, but it's very easy if you're to compound in it. So what if instead of looking for 50%, you're like, what if I just do 15% 3 times of the year? If you compounded that, that would lead you to 65%. And this is how people are able to get hundreds of percents or 200% return in their stock trading accounts. It takes a long time over a whole year. So they'll do 20%, 20%, 20%. And at the end of the year, they have a huge return, let me say, of about 90%. But it's not like they just got it at once. So it's all slow and easy. That's how you can get there. Before I go into the lessons and how you can master, because I did a lot of research for this lesson, I want to acknowledge that a lot of my knowledge is from, first of all, my experience. I've read a lot of books from Constance Brown, Gil Morales, who I love very much, William O'Neill, the OG, Mark Douglas, the OG, and Mark Minervini. These are people who have really crafted my mind and where I've learned a lot of my knowledge. So you're likely to see a lot of correlation between my work and their work. Or it's basically all the same thing. I just get a lot of information from the best traders out there, and I try to implement it in a way that I understand and is easy for other people to learn. So today we'll learn about impulse waves, those huge moves that we saw, how to always profit from them, what causes them, how to buy them, when to add to a position, how to hold them for maximum profit, when to sell them, what are the profit projections, and examples of successful ones, examples of failures, what you could have done and what you shouldn't have done. So after I studied 1,000 of my trades, I realized that a lot of my money was made on these impulse waves. So I decided to do a huge study of them in detail. I wanted to know, why do they start? When do they start? When do they end? Why do they end? What are the behaviors of a normal impulse wave? Because we're trying to make as much profit as we can. What is the ratio of the weeks that it sat down for to how much it actually moved? What was the industry of that stock looking like on the weekly chart? So I studied several stocks, 62 stocks, and I took about 2,000 data points. I studied tech stocks, finance, energy stocks, defensive stocks, industrial stocks, health stocks, and basic materials. So basically all the sectors in the stock market, and also cyclical. I collected a lot of data points. Some of the interesting data points that I tried to take were maybe what was the sector, what was the industry, was the industry bullish, what was the strength of the stock before it started moving. If I risked 1.5 average true range at the beginning of the move, what was the maximum profit that I could get? Then I wanted to know what was the normal percentage of the moves, how long was the base or the consolidation, how long did the stock sit for before it sprung up and went up there, and what was the base number, as I'm about to show you later. The results that I found were very shocking and they really opened my eyes. I was looking, were there any 2 red candles in the move? Were there any 3 red candles that were consecutive? Did the stock close under the 10-day moving average at any point? Did the stock close under the 20-day? I did a lot of research. And one of the things that really inspired me to make this study is that in my second year of trading, I remember I multiplied my account by 300%. And in 6 months, I lost it back all to the market. Actually, I multiplied my account times 3, or I remember it was like times 4. So I went from $1,700 to about $7,500. And I did all of this in just November, December, and January. But then I lost it all back to the market later on. And then 2 other times, I was up 50% and 60% for the year, and then I lost half of my returns to the market. So I got very angry at myself, and I was like, I'm not going to trade until I make an in-depth study into how these stocks work. Because I had taken a lot of the courses, I had read over 50 books at this point, and after what I have found, I don't want anyone out there to repeat my mistakes, so let's all build on each other's knowledge and continually improve. So in this session, I want you to master the art of making money from impulse waves. So we're focusing on just one part of the market. And when you master that, you can also master other parts and you can bring all the knowledge together. Learn how to make the biggest profit from the impulse wave. And of course, you'll feel proud of yourself. Now, as a trader, my biggest goal is to make the most money when I'm right. But again, I want to lose very little money when I'm wrong, because this helps us to compound our money. And every trader has a different personality. For example, I like swing trading, and that's what I try to focus on. It's because I hate waiting for months for stocks to move. So I'm not an investor. I also don't like losing huge amounts of money. I hate huge drawdowns in capital. I want my account to go about maybe 10% down max. I also like to think and analyze. I like to look at the long-term picture, where the stocks are going. Day trading doesn't work out so well for me, because I like to think and analyze, and then I trade. So swing trading brings all of these together. So what is an impulse wave? As we've all seen, stocks, they will move for a while, which is a very short time, and then they will rest for a long time, and then they can move up again. So stocks are like breathing in and breathing out. And there's so many reasons for these impulse waves. One of the reasons is that institutional investors, who are really the people that move the market, because we as retail traders, your friends that you see on the streets, those people cannot really move the price of a security, because you need billions of dollars to really move it. So institutional investors cannot buy in one day. They must buy over weeks and months. So I want you to imagine a trader that has some magician, some genie that tells them that, hey, there's going to be a famine in 3 years. And this is how you can think of these institutional investors. And currently, cashew nuts are sold at $1 a kilo. And when the famine hits, there's going to be very little food. The nuts are going to be worth $10 a kilo. So this institutional investor or this trader is like, man, I must buy 100,000 kilos of nuts from the supermarket. But the fact is that supermarkets don't have 100,000 kilos. So maybe they only sell 1,000 kilos per day. So he must buy over 100 days, this thousands of kilos. And of course, before he buys 100,000 kilos, he must have a really good reason as to why he's packing up all of these kilos. So institutional investors are not playing around. They've done their research because they're holding such large amounts of money. And if he tries to get all of these 100,000 kilos in one day, it's impossible because, first of all, the market doesn't have that many kilos in one day. And since he's also trying to buy a lot of it, he has to outbid other buyers because just tell a supermarket, hey, sell to me. I'm willing to pay a premium for it because I know it's going to be worth $10 in the future. And since he knows that currently the kilo is at $1 and it's going to be worth $10, he doesn't mind paying $1, $2, or $3 for it. So he's willing to bid up the price so that he can keep buying because he thinks it's going to be worth something in the future. And this is what creates these huge increases in prices. Now, when other traders also see that, hey, these nuts went from $1 to $5, they also want to get into the action, and that is us, the retail traders. So they also come in and start bidding the price up. And this is what normally creates these very strong movements in commodities. So trading is like the story of the farmer or the trader that I showed you before. But then lucky for us, we have access to all the transactions. We can see how many shares were bought on a certain day, and then we can also see the prices that these traders agreed on by the end of the day. So the first thing that we have to know is, what is a consolidation? After a stock moves, it sits and rests for a while. And after that, it can either go up or it could just crash and never recover. So I have some examples. So I already showed you examples of stocks that sat and went up, NVDA and SMCI. And then there are some stocks which crashed and never recovered. That's why I don't like holding stocks through their recovery, because sometimes they could take 5 years to recover them. I'm about to show you here. This is one of my biggest losses this year. I bought this thing around $10 and it went to $30. And then one day it just crashed, and I kept holding it. So you can see my entry. I didn't enter at that price. I entered about maybe around $10, $14, I remember, because I kept adding on. I think 14 was my average price. So you can see the thing gaps up and then makes a huge move up and then it collapses, And some people want to hold, but man, I'm not willing to hold something that has moved from $30 to $3. It's so bad. This is one of the stocks which I actually was thinking of as an investment in 2021. So it collapsed in 2021. This stock, Logitech, it actually has very good fundamentals. It had great sales. And I'm like, why is this company collapsing? The thing is making sales. It's making profits. Why is it going down? I was confused. The thing crashes. And then we can see that even after 3 years, it has not yet fully recovered. This is a weekly chart. So let's go into the findings of my research and then see how my trading changed for the good. The first thing that I found is that 97% of these successful big stock moves began when the industry was bullish. Now, one of the things which I learned very early on is that 97% of the moves began when an industry was bullish. And this is also proof that stocks don't move alone. For example, in 2024, semiconductor stocks have all been moving. NVDA, SMCI, AMD, Qualcomm. Crypto stocks in 2003, they lost their shit and they also started moving up so high. Solar stocks in 2007, coal stocks in 2022. So we only want to enter a bullish industry. And this is the most important thing. You can see 97% of stocks began when the industry was bullish. 97%, almost all of the stocks. That means the industry must be bullish. So rather than basis or any technical patterns that out there, the industry matters the most. And William O'Neill also found out that a stock move is 50% affected by the sector. What is a bullish industry? So first of all, industries and sectors are not the same. Technology stocks are a sector, but then there are industries within the technology. But within the sector, there are industries. For example, there's semiconductor industry, which has NVIDIA in it. There's a computer systems industry, which has other stocks in it. There is software applications like Adobe, which is also another industry, but they're all within the tech. So we just want to know a bullish industry, not a bullish sector, but a bullish industry. Stocks always move in groups. And of course, there's some rare occasions where stocks will oppose the industry trend. So the first thing is stocks move in groups. On some rare occasions, stocks will oppose the industry trend. But all stocks are always part of a certain industry. And we have to make sure that that industry is in an uptrend. TC2000 is the best for this. So TC2000 is a software application that you can use to see stock charts. So what you have to do is just superimpose the industry and the stock on the same chart. I think to do this is even free. just seeing the prices. TC2000 does not charge you to see the prices. So you can do this for free. Or if you don't have TC2000 and you're not willing to work that hard, you can go into TradingView, look at the industry chart, or look at the ETF of that industry. And you always want to make sure that the industry is at least above the 200-day moving average and the industry is trending. So here we can see leisure stocks in 2023. These boxes, as you can see, they are all starting on the same day. So Royal Caribbean Cruises, it moved 68% during that time. Norwegian Cruise Line Holdings, it did 62%. Carnival Palace, Carnival Corporation, which are very similar stocks, did around 80%. So all of these prices are beginning around the same time. It's quite interesting. Here we can see call stocks. So let's go back on the same day. You see that line? It's all the same. The vertical line on 14th of July, I start to track the prices and they all go up together. So you can see AMR does 186%. Consol Energy does 80% during that time. Alliance Resource Partners does 32%. Warrior Medical does 84%. So industries always move together, but not all stocks in the same industry are going to be moving by the same amount. Some are stronger than others, and we'll see what makes those stronger later in the video. Here we can see a chart in TC2000 where I compare SMCI versus the computer system industry. This white line is the day that the stock jumps out. We can see on this white line the day that the stock jumps out, the industry is bullish, and then we can start following the price. Look at how it goes with the industry. When the industry is crashing, it crashes with the industry. When the industry goes up again, it tries to go up with the industry. So these stocks are always following the industry. And you might think that, hey, maybe this happened one time. But I'm like, no, it happened before as well. Here, it's not as clean, but you can see once it jumped up before the industry was ready. Up here is the industry chart, by the way. This is the stock chart. And then here, once it starts moving up, the industry is moving up with it. This part here where the industry is correcting, it corrects with it as well. And then this last push that the stock has, this last 63% push, it goes up with the industry. And that's how you can see that the industry is bullish. Now, of course, we can also see the same thing in NVDA. We see the day the stock jumps out. I have the beautiful lines for you here. You can see that, hey, when NVDA breaks out on that day, while it's going up, the industry is going up. They all correct together. NVIDIA is so big that it actually affects the price of the industry itself, but you see how very similar the price chart of NVIDIA and the industry is. 3% of the time, the stock will oppose the industry chart. So we can see here that ASPN is going up, but the industry, which is the chart up, is going down. So you see on the industry chart, we have the 20-day moving average, and that's the chart of the industry up there, and then down here is the chart of the stock. You can see that while the industry is going down, ASPN is struggling to go up. And why is it struggling? Because it's swimming against the tide. So we can see it's opposing, and that is not looking so great. So even if you bought the stock here around $27, it only moved up $3. So you're not really making a profit. So avoid stocks that are not in a bullish industry. So the second thing that I found was that 77%, almost 80% of the stocks were super growth stocks. That means these are young companies making astronomical returns. So what do I consider a super growth stock? It must have two of the three conditions below. It must have good earnings, good revenue, or a good return on equity. Super growth stocks that are growing like crazy. And I told you that they must have two traits. They must have two of the traits below. They must have either a super earnings per share growth, they must have a super revenue growth, or they must have, what is a super return on equity? It is an return on equity that is 15% and above. What is a super earnings per share growth? If you look at the quarters and you lay them out, I want the year-over-year growth for the last 2 quarters to be above 50%. Or I want the year-over-year growth of the last 3 quarters to be above 30%. And what is a super revenue growth? Any one of the following. It has averaged a 15% growth year-over-year for the last 4 quarters, or it has done 20% year-over-year growth for the last 2 quarters. Now, of course, it's very hard to remember these in your head, but what you can do is to eyeball them. So in TradingView, there is this table over here. You can get it. It's a financial table. You just put it over there, get the last 5 quarters. I just eyeball it. I look at the revenue. Are the last 4 averaging 15 or the last 2 averaging 20? Same thing for the EPS. Are the last 3 averaging 30 or the last 2 averaging 50? If you see things over 100, over 1,000%, man, you got to get in there because that thing is great. It's a great stock. And over here, we have our return on equity, as you can see, 22%. Here's another chart. This is Powell Industries. You see how the thing shot up. But if you look at this growth, this thing is growing like crazy. And the most important is actually revenue growth. I used to think it was earnings, but actually revenue. When a company is growing its revenue, that means a lot of people are buying its products, and that normally pushes stock prices. When you see revenue growth of above 30%, of above 20%, that stock is very likely to move. And if it's also making huge profits from that revenue, oh man, it's just a concoction for success. So you just eyeball this table. And here we see an example of AMR. Despite the fact that it moved, it was not a super growth stock. It did not have 2 of our conditions. It did not have the revenue. It didn't have EPS. It only had a good return on equity. The third finding that was really important is that 96% of these really huge moves, either from a first or a second base. 73% of stocks were from the first base. And that means they had sat down for several months and they're just jumping out for the first time. The first base is normally formed during a market correction. The second base is normally the first time the stock sits on its 50-day moving average after it jumps out of the first base. So 23% of the moves were from the second base. So when it reaches the third base, just know that, man, the chances are very slim because now everybody has seen that the stock is moving. People have already gotten their profits and they're ready to sell. So the biggest moves are from a very big base and the first consolidation after a big base. So these are the first and second bases. What is a base? A base is a consolidation or a correction that is at least 4 weeks. This means that the stock has moved and it is sitting down for at least 4 weeks, at least a month in a calendar. 3 weeks is not a base. For a base, there must be 4 correctional weeks. I'm going to teach you how to master bases in another lesson, so you want to stay subscribed to this channel. I'm going to have a group of fundamental videos that will teach you all the fundamentals that you need to know to get started in the stock market. But I can't teach them all in one lesson. It's a lot of work to make up these slides and also record these videos. So we can see here in videos, base 1. When you're looking at charts, you always want to make sure that you look on a time ratio of at least 1 to 4. So here I have a 4-day chart. On this side on the left, each bar there represents 4 days. Each bar here on the right represents 1 day. It's a daily chart. So base 1, the stock was sitting for 175 days. The price didn't move. If you went in a corner and woke up 175 days later, the stock was at the same price. And then it jumps out and does 95% in 60 days. And then it has another consolidation of about 47 days, which is about 1.5 months. And then it jumps out again. So that is what you call base 2. This is base 1. We can see FSLR base. This is a stock that I just got recently and I sold too soon. I was mad at myself, but you can see it's base 1. This is something called the cap and handle. Of course, you'll learn it in another lesson. Don't worry about it for now. Now we're just focusing on the impulse wave, which is this strong move. It jumps out, does 70% in 40 days. This is base 1. It has not yet formed the base 2. Now, when this thing forms the base 2 and touches the 50-day moving average and jumps up, it's a good time to buy it. AMR, we can see base 1 was 375 days on a 4-day chart. Sits for a long time, goes 60%, sits down, does its base 2, and then does 120% in 100 days. And after that, it actually has never recovered to that price. Currently, it's around $300. It crashed. Another thing that I had in my research is how did the moves begin? I realized that a quarter or 25% of the stocks set it up as gap ups. The stocks gapped up or there was earnings. And 75% of stocks will just have a normal move. So what is a normal move? A normal move is just a stock that just has normal bursts. There's no gap up in the pricing. A gap up is when the stock has at least 3% in the gap up in the price. This could be due to economy or it could be due to the earnings. And I realized that a lot of these impulse waves actually had earnings that fueled the move in the middle of the move. That was quite interesting. So here you can see that the chart of why did it start and what was the percentage of the move. So earnings, when a stock started with earnings, the average move it did was 120%. So whenever you see a stock jumping out of a huge base because it has reported great earnings, then you can know that you can expect a listed stock to move maybe 80 to 120%. The stocks are set up normally without some huge excitement, and they just had normal bars. Those normally did about an 80-90% move. And those that just gap tap without any news, but it's jump tap, they also were very similar to a normal move, and they did about 80-90% move. So this is an example of a normal move. So you can see here once it gets out of the base one, there is no excitement. The price is going up. The price is not jumping out of the base. Like it's just going up normally. So this is an example of a normal move, or what I considered a normal move in base one. So here in base two, you can see it gapped up a little bit. I don't know if you can see it here, but I'll show you another example of a gap up. But here, base one, it's a normal move. And then up 11, this was some nice profit for me too. I remember this one. It had sat down for 5 months. And we know what to expect when a stock with great earnings is just sitting there and it reports some good earnings. So you can see on earnings day, the thing gaps up out of this huge consolidation. So the thing went from once it gapped up to about $55 and went to about $86. So this was a really nice move, really nice move. So this is an example of what I meant by an earnings gap up. Another lesson was 75% or 3/4 did not have 3 red candles that closed under the 10-day moving average. So now here it gets a little bit complicated, but don't worry, I'm about to take you over it. What are 3 red candles? I consider a red candle to be a day where the price closes lower than the previous day. I know some days the stock might open at $10 and close at $9. So it has closed lower than it opened, but has it closed lower than the previous day? Because it's all about the psychology of the traders. It's not about today. It's like, how has it done in the past? So only red if it closes below the close of the previous day. So I have to look for 3 consecutive candles. Candle 1 is any red candle. So that's always candle 1. Candle 2 is a red candle that closes under the low of candle 1. Then candle 3 is any other red candle that closes under the low of candle 2. And there cannot be any more than 2 candles between any of these candles. So what I mean is that between candle 1 and candle 2, the maximum number of candles you can have is 2 candles. Between candle 2 and candle 3, the maximum number of candles you can have is 2 candles. Beyond that, it has lost its vigor. The count doesn't matter anymore. So if I see any more than 2 candles, I just reset my count. So here is an example of how I use this red candle. It's actually one of my exit strategies because I know that 3/4 of them shouldn't have red candles that close under the 10-day moving average. So here we can see Tesla, while it's trying to pick out. So one of the first times. It breaks out around $24. Now the thing has doubled. It's already at $60. So red candle 1, we can see the first red candle here, which actually is forming a resistance. This is something which we call a double top. It's failing to go above this price that it did before. So that's red candle 1. Sometimes a lot of things come together. Red candle 2 is the second red candle. So the yellow line is a 10-day moving average. The blue line is a 20-day, and this white line is a 50-day. And we see the red candle 3 closes below the 10-day. So here I just know, man, just get out. And we can see what happened after. Went from $52 to $24. So just get out because it had already doubled and stuff. So we can see Tesla again, 3 red days. This is another Tesla move, the 120% move. It jumps up. It has already done 100%. The stock has already doubled. What else can we expect? Are we expecting it to go times 10? Stocks don't move like that. We have red candle 1. Red candle 2 closes under the 10-day. Red candle 3 closes under the 20-day. So here, I would have just, gotten out here around 260. But actually, it recovered for a little bit, and then it crashed. And by the way, Tesla, did it recover to this price? Yeah, actually, it did. Another example of 3 red candles. We can see this is ASC, a shipping stock. We have a 4-day chart, daily chart. Jumps out on earnings. You can see the volume here. Huge bar, a huge price bar goes up. We see a red candle. This don't count because I said it might count here, but then it didn't close under the 10-day. So I start to count again. 1, 2. So 2 closes below 1. Then there's a green day where it goes up. And then there's now the third red candle here that closes under the second one. So here we can see between red candle 2 and between red candle 3, there is a green candle there. So this already keeping track. It closes below the 10-day. This was the time to sell. This was coming from a fast base. So what I expect is this thing to bounce off the 50-day. If it bounces off the 50-day and recovers, it's also going to be a good buy because we always get 2 great chances. The first big breakout, as we can see, a base one, and then we can wait. So some people are going to hold through for the stock to recover here, but I'm not that patient. I get out. I don't want to see my stock go from $23 to $20, or Tesla, how it went from 280 to 177. I don't want to see that stuff. I like my money. Another finding, which is quite interesting, during these impulse moves, 80% of the stocks didn't have a close under their 20-day exponential moving average. So let's see. Whenever a stock closes under the 20-day, then I know that now I have an 80% chance that a correction is beginning to start. 80% chance, which is really huge. So you can use that information however you want. 77% of stocks lasted less than 60 trading days. These impulse moves will last less than 2 months, as we already saw. The average hold was about actually 1.5 months, 43 days. Median hold was about just 1 month, 37 days. When you're swing trading, you can expect the stocks to move from anywhere from 2 weeks to 1.5 months holding time. This is the average. And during this time, you have time to review and look for other opportunities. Some trades take so long, they even take 5 months. But for most times, these powerful moves, you can see how long they take. And here we see the average base length per sector. How long did these stocks sit? Since I used the 4-day chart, each bar means 4 days. So when you see the base length is 10, that is actually 40 days. So industrial stocks sit the longest. Technology stocks sit for a very short time. So 12 times 4, which is about 48, 50 days, around 2 months. That's how long they're going to be sitting for. Quite interesting. So the next thing that we have to do before you can learn the rest of the lessons, or the thing that I found, is if you're already a pro and you already know these things, skip on to the next huge finding that I found. But for the beginners, sit through this. We have to think like a casino as traders. So a trader always knows that, hey, I want to sell this stock at $140. I'm buying it at $100. And if it goes to $90, I know that my idea was wrong, and that is my risk. So my risk is $10, but my potential reward is $40. So that means that I have a risk to reward ratio of 1 to 4. For every dollar of risk, I can expect $4 back. And this also means that if I'm winning $4 every time I win, and I lose $1 every time I lose, that means that I don't have to win every time to be very successful. With a 40% success rate, that means that if I win 4 out of 10 times, I'm going to make, because my risk to reward ratio is 1 to 4, that means I'll make 4 times 4 minus my losses, which are going to be 6 times 1, which is 10-hour profit. So 4 wins times $4, because my risk to reward ratio is 1 to 4, minus 6 losses times $1. So if I play 10 times and I only win 4 out of 10 times and I'm risking $1 every time, that means I can expect 10-hour profit. So hour is the amount of risk. The risk is relative. If you have $1 million account, you might be risking $1,000. If you have only a $1,000 account, you're risking $10. So that is what I mean by R, relative to how big your account is. If I have a 30% success rate, I'm winning 3 times 4 minus 7 times 1. I'm still profitable, even just winning 3 times out of 10. If I win 2 times out of 10, that means I have 2 times 4 minus 8 minus 1, which is just 0 R. That means even if I only win 2 times out of 10, that means I am breaking even. Isn't this a nice thing to know that for every 10 tries, you only need to win 2 times to break even? Any other than that, you're profitable. And this brings us to risk to reward ratio. So we're assessing our potential returns for every amount that we risk. So we saw that a risk to reward ratio of 1 to 4 means that for every dollar we risk, we expect $4 back. And this is how casinos think. This is how investors have to think. So never think in terms of absolute gains. Don't think in terms of 100%. The stock is moving 100%. You must know what percentage are you risking and what are you getting back. If you risk 1% to get 100%, that's beautiful. But if you're risking 50% to get 100%, then it's not as good. You still got 100%, but you risked 50%. So that means that the size of your account doesn't matter, because if you said 1 hour is 1% of your account, 1% of $1,000 or $1 million, it doesn't matter. Both of you are going to be getting the same risk to reward ratio. So that's why I like this way of thinking about trading. It doesn't matter the size of your account. For those starting out in your lives and you have very small accounts of $5,000, it's going to be the same knowledge when you later grow in life and have an account of 500,000. The knowledge doesn't change. It doesn't take any more confidence to buy 10 shares than to buy 1,000 shares. That is one thing which I learned from Jesse Livermore, who is a legendary investor. He found that when he bought 10 shares or 1,000 shares, it didn't take him any more courage. And then another important lesson is average true range. So average true range is just a way of measuring the volatility. It's an indicator. It shows you the average range that the price has been moving per day for the past 14 days. So ATR 14 means for the past 14 days. So average true range is the average of the ranges over a period of time. So when I say ATR 14, the average of the ranges over the last 14 days. And I use this to measure volatility. It has nothing to do with predicting price, but it helps me normalize trades, because if a stock moves 100%, but it normally moves 10% per day, that means that it has moved 10 times what it normally does. But if a stock moves 100%, but it normally moves 5% per day, that means it has moved 20 times what it normally does. So this helps us get the real strength of moves. That was just a preparation for me to show you what was the average risk to reward ratio per sector. So for every sector in my studies, I used the risk of 1.5 of the average true range of the last 14 days. So I realized that cyclical stocks had the best return. As for their strong moves, they brought about 20 risks back. For every dollar you risked, you got 20 back. If you risk $1,000, you're getting $20,000 on cyclical stocks. Energy stocks were the most selfish, as they only brought something less than 10, maybe around 9. Technology and cyclical, as you can see, are very nice sectors. That's why I pay very strong attention to cyclical, technology, and industrial stocks. They have nice returns when they move because they're very profitable. I need you to remember these things because, man, this is very important. 97% of stocks began when the industry was bullish. So you should only, I repeat this, only enter bullish industries. I realize a lot of my losses always come when I'm not in a strong industry. But not only do you have to enter the bullish industry, you must also enter the strongest industries. I'll show you later how to know an industry is stronger than the other. 77% of stocks were super growth stocks. Ideally, if a stock is a super growth stock, it's in a good industry, it's a recipe for it to be a good move. So try to leave those stocks that don't have earnings. So avoid bad businesses. The only time I have an exception is if there is hype. Now, crypto stocks aren't making money, but everybody was talking about crypto. So I knew that, hey, these things are up to something. Bases, try to focus on the first and second base. When the third base is forming, like I showed you, it's risky because of our very strong moves, only 3.6% were from a third base. So all these historically great stock moves are only from the first and second base. The third base rarely brings good returns. So we might as well wipe it out of our thoughts. Focus on 1 and 2 because we want high quality selections. When I was younger, I always wanted to take every opportunity that comes. Once you grow older and you get more experience, you're like, man, I only want it if it's good. I only want it if it's worth it. It must be coming from a first base or a second base. Other than that, I don't want it. 26% of stocks will start as gap ups and 75% will have a normal move. So when you see a stock gapping up in the morning and it's coming out of a huge consolidation, don't start being scared that it's up 20% at the beginning of the day. Get into that thing because we've seen that those stocks are likely to move up 100% after that. And its gap ups after huge consolidation are amazing entries. 80% didn't have 3 red candles that closed on the 10-day moving average. Whenever you see those 3 red candles that I told you earlier, then you should know that, hey, maybe I should reduce my position because now I have an 80% chance that this stock is about to collapse. Sometimes for me, it depends on where I am. If it's very early in the move, I'll just be careful and I reduce my position. If it's very late in the move and the stock has already gone up 100% and I'm seeing these 3 red candles, I'm out. I just take the whole thing out. 80% didn't have a close under the 20-day moving average. So when the stock closes on a 20-day moving average, I normally reduce my position because I realize I can just add it back in case it was a fake out. I don't really exit the whole position. I reduce. 77% of stocks lasted less than 60 trading days. And I realized that my risk to reward ratio wasn't affected, the IBD relative strength at the start of move. And I hope this lesson has been really mind-opening for you. We've only focused on how impulse waves act. You want to know how a stock is supposed to be acting. So the purpose of this lesson was for you to see how the stock acts. When is it wrong? When is it correct? In my other lessons, I'm going to teach you bases, how it's supposed to act in a good base, and how you can sell for a profit, how to enter and how to sell for a profit. So, hope you've enjoyed this lesson. If you found value in this lesson, please subscribe to my newsletter. Please subscribe to the channel if you're watching this on YouTube, and may the markets be with you. Thank you for your time.